now we get into the stuff that I think is really critical, really important to understand. So the game has changed. This is a probability distribution. So when it's tall, like that, that means we have a very narrow range of probable outcomes. We're talking about market outcomes, investment outcomes, okay? When it gets wide like this, that means we have just almost anything can happen. We can have huge phenomenal upside. We can have scary, awful downside, and anything in between. And there isn't any way to prove one way or the other. So it's right here that I want to talk about how our portfolios did this last year. And not just how, but why, okay? So our average, so the S&P was up 16. Our aggressive or our growthy portfolios were up about 14. But the important thing to realize is the returns didn't come from equities. We're about 50% equities in our growth portfolios. The returns came from the proper use of bonds. So we have 3 different pieces of our bond portfolios, each of which were up over 20% this year. High yield, municipal high yield, and emerging market debt. So our performance came from something that, while still volatile, pays you a dividend and isn't something that, if it goes out of business, you're the last one to make money. So we protected capital in a way, just in case we saw this. Just in case we saw a really bad negative outcome. And so I'm going to suggest, and I've said this to everyone that comes in our office, our promise, the thing that we are committed to, is maintaining lower volatility. So how does that translate? So the S&P's largest drawdown in 2012, the S&P lost 14% between, I'm not going to get the dates right. It was at the end of the first quarter, first couple months until June 1st, okay? So our largest drawdown was about 7%. So we have half the negative return in the market in the worst period of the year and like 80% of the upside. And I think that's the way we have to manage it going forward. And I'm saying this now because I know that there's 2 or 3 people in here who are going to come into my office and say, how come we didn't get the return of the S&P? Because I know who you are. And that's why. And I'm going to say, don't go for the return of the S&P this year. This is where that patience and discipline is so important because there's so many things that can unravel. At the same time, if it doesn't unravel, we are off on another growth phase. We will see those jobs. As we tick away these other issues, you know, Europe gets together. As we resolve, you know, we just kicked the House, you know, kicked the 3 months down to, was it June, they said? May. So we're going to talk about the debt ceiling in May. Between then and now, we're going to figure out, you know, some way to cut the deficit a little bit. It sounds like that's a huge positive. Not because, you know, they've resolved anything, but because the Republicans are making a step to say, listen, we're not going to kill things. So I think that might be the first step towards them working together, at least I hope. Okay. So we're at this inflection point. It could go either way based on some things we're going to talk about in a second. A wrong political decision, going to austerity in the United States. If we went straight to austerity, we would kill it, which is stupid, right? We won't do that because of that. In fact, you know, well, the problem is that's what's legislated. We keep kicking the can down the road to austerity. What we need is we need a nice, smooth glide path, which means deficit goes from 10 to 8 to 7 to 6 over years and decades, not the next 3 years. That's what's hurting Europe, is they went immediately all at once, okay? So this is, if you read New York Times, if you read Krugman, this is what he's saying. And he's right, and it still scares me because I don't like to have $16 trillion deficit, or debt, not deficit. That's huge and terrifying, and I don't know how we unwind that. He says we don't have to. I don't know about that. I think there's a point where the bond market says no, and that's the point I'm afraid of. Up until that point, I say we spend more money, but we hit that point, there's no turning back.
He says the same thing.
Yeah, but we don't know, but the issue is we have to stop before the point. You know, we don't know when that point is. That'd be useful information. See, this is corporate investment, okay, business investment. And you can kind of see from the third quarter of 2011, it's just been on decline. We think that the fourth quarter of 2012 will be a positive. But why is that? Why is it that companies are retrenching and not investing? Any ideas? I don't think that's, I think there's plenty of consumers. I think they're scared. I think they're waiting. I think the uncertainty thing is real. And if either Republicans or Democrats give a little bit and meet in the middle and just resolve it, I think the growth is there. I think innovation is there. I think hiring is there. But we have to not have this huge looming question. We're talking about hiring. And we're talking about, now, do we wait 3 months? We just don't know how it's going to get treated. And we're a teeny tiny little company looking at hiring one person. If you're a huge multinational and you're wondering, do I build something here, or do I build it in China? There's a lot of questions here. And we need to just resolve the questions. And if we can resolve those questions, that's what gets us there. That's what lets another growth spurt begin. So China, you can kind of see this. This is the flash manufacturing. So it's been on decline. And the hope is that this is real. And this is 100% due to the change in power. And they've also stimulated. Right? They've also spent money. Because remember, China runs a surplus. They have arrows in the quiver that they can employ to stimulate growth. We don't have as many arrows, but man, we can borrow at cheaper rates than they can. I don't know which is better. This is the big question: is our stocks, are they rich? Are they fairly valued? Are they good values right now? It all depends on which PE ratio you look at. So does everyone know who Shiller is? Yale economist Shiller. So Shiller was the first person to start using a smoothed PE ratio. He takes current value divided by the average earnings over a 10-year period. And there's another guy named Hussman that uses a 7-year period. And what that does is it gets rid of a lot of the huge ups and downs. That PE ratio says that we are overvalued by about 30–40%, which means Hussman and Shiller expect a pretty massive drawdown in equity valuations. Okay, that should be scary. However, the current PE is in about the 13 range, which is below the average for a 1-year, non-smoothed earnings or PE ratio. So which is right? PE ratio is just the price of a security divided by the earnings of that security. So here we're looking at the PE ratio of the S&P 500, right? And so it's a measure of valuation. So back in 1999, 2000, the S&P valuation, S&P PE ratio was like 40-something, which is stupid high. We should expect markets to collapse if you have that kind of a PE ratio. Okay, right now, they're 13. There's a lot of work that talks about PE ratios bottoming just below 10. If you can buy something below a 10 PE ratio and be patient, you'll end up being pretty well off. So 13 is not far away. So the issue is, or the academic issue is, when you look at a 10-year smoothed PE ratio, when one of the years has 0 earnings, is that a realistic representation? So 2008, there were 0 earnings, right? So when you put that into the average, it might skew it higher than it needs to be. This is space we do not know how this turns out. JP Morgan, Goldman Sachs, all these big guys say 13. This is the one we should look at. Schiller, bond guys, Hussman, they all say that the 10-year, 7-year smooth is a more accurate representation. And actually what Hussman says is the 7-year smooth PE ratio has a higher correlation with long-term returns than the 1 year. I believe that. So you look out 10 years using that, and he says it's overvalued. So that should. What is the 7-year PE? 22. The 7 years 22. So the PE ratio is about 40% overvalued when you look at it on a smoothed 10-year basis or 7-year basis. Okay? So that should tell us to be cautious of equities. Consumers, you can kind of see how they felt here, and they've just gotten better and better and better. A lot of that is due to we've paid off a lot of debts. A lot of debts have been forgiven, written off. So our debt ratios are incredible. Haven't been this good for 30, 40 years. And we're starting to see those debt ratios bottom out, which means consumers are getting more interested in borrowing. There's always been people interested in borrowing, to your point. The question is, did they qualify for the loan? So banks are getting more interested in lending, and consumers, basically because the low-hanging fruit is gone, and consumers are getting more interested in borrowing. This could be a moment where we start to see things heat up again.